Hi, everyone, and welcome to UBS Trending. I'm Anthony Pastore. Here at UBS Trending, we are continuing to follow the markets and, of course, the volatility and bring you the brightest thought leadership from UBS and our best partners. Joining me for this conversation today is Erin Brown, Managing Director and Portfolio Manager at PIMCO and a great friend of the studios. Erin, good to see you.
Nice to see you.
And you're in town from the West Coast. It's always great to have you here when you're here. My gosh, we were just talking about it right before we started, how the volatility is really a head spinner these days. And that's where I think we should probably start. We're looking at inflation, and we know it's historic, but the volatility itself is just, investors are scratching their heads. They don't know what to do. So what can investors expect when it comes to the inflation side of the story? I would say for the remainder of this year, as we're getting very close to year end, and even into 2023. And kind of part two of that is, do you think the Fed has things under control, the way that they're making these moves?
Yeah, so I always say that market volatility is driven by economic volatility. And so when you have significant economic volatility like we're seeing today, and specifically with respect to inflation, you're going to naturally expect that market volatility is going to follow suit. So we're not going to have, I think, market volatility subside until we start to see economic volatility subside. Inflation is really driving the train right now, as you noted. And with respect to inflation, our view is that inflation is likely in the process of peaking. We're probably past peak inflation with respect to core, but we'll still have, over the next couple of months, we'll have sort of a peaking in headline inflation, which ultimately is being driven by oil and commodity prices.
Right.
And within Europe, and sort of taking a broader lens, we're likely going to peak with respect to inflation towards the tail end of this year, early next year in Europe. So you will see global inflation, start to peak over the next couple of months. That said, and what I think the market really should be focused on right now is not necessarily just the peak of inflation, but what is that path of inflation from the peak on downwards. And I think that's where it's a little bit trickier. We're likely to see inflation remain sticky. Particularly as we've seen the sources of inflation move from more durable good inflation to services inflation, which tends to have a stickier path. And it's likely to remain elevated, over the next year or so. And so it's going to be persistent in terms of the elevation. We'll likely not get back down to a level which the Fed is really comfortable with until the end of next year.
Right.
And so, so it's going to be this sort of gradual move down, which is going to feel really uncomfortable for several more months. And so I think that's what the market right now, and specifically the Fed, is really grappling with. With respect to the Fed, when you look at forward break-even inflation, whether it's 10-year break-evens or 5-year forward OIS swap inflation, it still remains relatively anchored. It's, certainly has moved, higher over the course of this year. It's at levels where, even the Fed in recent speeches have mentioned that they'd like to see that move lower again. But I don't think that inflation has become de-anchored, by any means, by any stretch of the imagination in the forward space. And so, I do think that the Fed has inflation at least somewhat under control, at least with respect to how the market's viewing it. But, I do think the Fed is worried here. And so I think the real restraint right now in terms of, helping along to, sort of stave off any recession is that the Fed's hands are tied behind their back because inflation is going to remain elevated. And so that does mean that the Fed is going to be constrained and restricted with respect to any type of response that we get to economic shocks.
Right.
And so that's the real risk.
Yeah, and it's and back to what you were saying about peak inflation. I'm glad that you followed up with what you said, because I think a lot of people ought to hear the words peak inflation and they automatically think, oh great, in just a couple of weeks I'll see prices at the store start to decline, or my gas prices will go down, and it's going to be a nice straight line like a roller coaster from the top of the hill down to the bottom. But as you described, the stickiness will stick around, and we'll have some, you really put it perfectly, uncomfortable probably months following that peak, whatever that peak looks like and when it's going to be. But clearly the Fed and Powell, they really have their jobs cut out for them these days, and in sort of an unprecedented time coming off of a pandemic. We've got a war in Ukraine. insane inflation because of supply chain issues and shutdowns in China have continued. So with that volatility then, Aaron, that we've seen, especially just this past week, we had equity markets rallying for the first 2 days of the week. The Dow, I think, gained 1,000 points or more in just 2 sessions. Meanwhile, we are still right near the lows of the year over a 1-year period. So what's really driving that volatility, and how long do you think that will last?
So I think what's really driving it is this economic uncertainty and this inflation, this economic volatility, which is really driving market volatility. And I think it's going to last until we see credible signs that we've moved past peak inflation, that we've moved past peak Fed hawkishness, and we start to see stability within the core of what all risk markets are priced off, which is core fixed income.
Right.
You're not going to have economic or equity volatility and risk asset volatility subside until we see core fixed income volatility subside. And that right now is really being driven by inflation. And so
is there a clue then that that means that the Fed would have to stop tightening and take a pause for that to feel like we're at that place where volatility might start to dissipate a little bit?
So I don't think we need to see a pause. Like
Okay.
The Fed, I think, is going to probably hike rates to 4.5% to 5% and then pause. I think that the markets will anticipate that pause well in advance of that move to 4.5% to 5%. But I do think that we need to see credible signs that inflation is starting to move lower and on a clip that we're getting closer and closer to that 2% inflation sort of threshold for the Fed. And in order for that to happen, we need to start to see signs that we're not going to see runaway inflation on the services side, that some of the risk around Ukraine and Russia has started to sort of ebb, and we're not going to be hit with these sort of exogenous shocks, which could lead us back to another inflation regime. And so it's going to take several months of healing before I think the market really feels comfortable that inflation really has moved past the peak, and that the Fed is on a credible path towards more, or at least not more hawkishness, but start on a credible path to arresting the increase in inflation.
Right. I was talking to a friend of mine recently who's not in our industry, and she said something about the markets. I said, look, at the end of the day, what they should teach in every finance class at school is like if there's uncertainty, the markets don't like it. And that's pretty much like you can go ahead and graduate then, because we know markets hate uncertainty, and that's really where we are. So it makes a lot of sense that this volatility is really being driven by the inflation that we're seeing and by these people expect to see what the Fed is going to do, but the Fed is even just trying to say, we're going to go day by day and see how it looks.
Yeah, I think you're exactly right. And the challenge that the Fed has is that they've been behind the curve,
That's right?
They missed both the disinflationary trough that we saw, past, following COVID, and now they completely missed the persistence and the elevation and the acceleration in inflation.
So they're making up for it a little bit these days.
They're absolutely making up for it, and now they're sort of ripping up the playbook, sort of tearing up forward guidance and saying, like, we don't know, right? We're going to take it meeting by meeting, and that's an uncomfortable place for the Fed to be in, and it's an unprecedented place for the Fed to be in as well. And so I think as a result of that, the market's really going to need to see credible steps of the Fed and feel confident that the Fed has it under control, which is going to take longer than maybe the benefit of doubt that we've given them in the past.
Right. I think you're right. I know you're right. I mean, the markets need to feel confident that the Fed is confident in the direction they're going. Right. It's all about that confidence level, right? Yeah. So this begs another question for you, Aaron. Is where do you think right now there are opportunities, whether they're pockets? We're talking equities, fixed income, and credit. Even stepping outside of that traditional 60-40 kind of portfolio, where do you see those pockets today?
Well, so first, as I mentioned earlier, in terms of the sequencing of risk, first order of effect is you need to stabilize the core. You need to stabilize fixed income. Mm-hmm. So I think money's first going to go flow back into fixed income. That's where I think valuations right now look the most attractive. We've seen a significant sell-off. So if you're a medium to long-term investor, fixed income is starting to look at these yield levels pretty attractive. You can lock in, short-term 2-year paper, 4% plus, returns over the next couple of years, add on top of that a little bit of credit spread, call it 200 basis points for high quality IG paper, you lock in 6%. Like, that's not a bad place to own for the next couple of years, particularly because if it's very high quality paper, that's money good, right? Same thing with, sort of taxable munis for, an investor that is able to take advantage of that sort of, improved tax rate. So you can get good return right now from high quality fixed income paper. And so that's where for investors with a medium to longer time horizon, that's where I would start to invest today. Short term, you may see a little bit of volatility, may see some mark-to-market risk, but if you're able to withstand that, sort of hands down, the expected return from fixed income, on a relative basis, given volatility, is, I think, much better than equities. From an equity perspective, I think it's going to take time to heal.
Right.
You're going to need to see core fixed income stabilize, then moving out the curve a little bit, mortgages, then credit, and then equities. And I still think that we have further downside from here. Forward earnings expectations next year for the S&P 500 are still up 7% next year. Historically, in recessions from peak to trough, you've seen about a 27% drop.
Right.
Our earnings estimates at PIMCO, which are sort of proprietary to us, are looking for high single-digit negative earnings next year. So that's plus 7% where consensus is,
right.
Negative, call it 7% where we are. That's like a 15% differential. I still think that the market needs to trade down to a more realistic earnings number before you can start investing in equities. High quality equities is a safe haven. Healthcare, which has underperformed, I think that's a good place to invest. We're defensive oriented equities as well. But anything that's sort of cyclical, anything that's tied to European equities in particular, I think are going to see further downside from here.
Yeah, I mean, we're keeping an eye, obviously, on Europe as they are having a tough time economically. We see it specifically in the UK. We see the way currencies are reacting. The US dollar has some strength these days versus the euro, the pound sterling, even the yen. So it's a really compelling story. And certainly this is a time for the history books. A lot of finance and economic majors 10 years from now are going to be reading about what's going on in the markets these days. But again, Erin, always good to have you here. Thanks for joining. Love having you here in the studio. Next time you're visiting the Northeast, please come and see us.
Hopefully not during a hurricane next time.
Hopefully not during, exactly. We'll get you during better weather. Coming from Southern California, it's hard to come to the Northeast during October. So thank you, Erin. Great to see you. Great. Erin Brown from PIMCO. And for more information, please visit our website at ubs.com/views. Plus, you can check out all of our content on social media, LinkedIn, Facebook, Instagram, Twitter. Plus, all of our past UBS Trending episodes are available on demand on our website as well as the UBS YouTube channel. And if you have any questions about anything that Erin and I spoke about today, please make sure to reach out to your financial advisor. Until next time, I'm Anthony Pastore. We hope you have a great day, everybody. And remember to keep your eyes on what's trending. We'll see you soon.